tech stocks are selling off before Nvidia. There is something strange happening in the stock market right now. Nvidia is about to report earnings, and instead of investors rushing to buy the world's most important AI stock, they are selling, not just Nvidia. Across the technology and semiconductor complex, investors are suddenly getting nervous. Memory stocks have been hit, chip makers have been hit, AI infrastructure names have been hit, and Nvidia itself has entered one of its longest losing streaks in years. That creates a very uncomfortable question. What if the market isn't afraid that Nvidia will miss earnings? What if the market is afraid that Nvidia can beat earnings and the stock can still fall? Because that is a completely different problem. And it could affect almost every major technology stock connected to artificial intelligence. Tonight, we're going to break down what is happening, why investors are selling before Nvidia reports, what Wall Street is actually expecting, the number Nvidia absolutely has to beat, the number that may matter even more than revenue, why a massive earnings beat might still disappoint investors, and most importantly, what this could mean for the entire AI trade. Because Nvidia's earnings are no longer just about Nvidia. They have become a referendum on the AI boom itself, and the market is about to vote. The first warning sign. Let's start with the obvious. Nvidia has been one of the biggest winners of the artificial intelligence revolution. For years, the pattern was simple. Nvidia reports, revenue explodes, data center demand surges, management raises guidance. Wall Street raises price targets, and the stock climbs. Again, and again, and again. But this time, something feels different. Nvidia is approaching its August 26 earnings report after a prolonged period of weakness. The stock had already fallen for several consecutive sessions going into the report, and the semiconductor sector has been under pressure at the same time. That matters, because when one company falls before earnings, it can be noise. When an entire group falls together, you have to ask whether investors are changing their expectations. And that is exactly what makes setup so interesting. Because the market isn't saying AI is dead. The market is asking a much more dangerous question. How much growth is already priced into these stocks? Think about that. A company can have fantastic earnings and still have a disappointing stock reaction. Why? Because stocks don't trade on whether a company is good. They trade on the difference between reality and expectations for Nvidia are enormous. The number everyone is watching. Wall Street is expecting Nvidia to deliver roughly $92 billion in quarterly revenue. The company itself previously guided toward approximately $91 billion with a plus or minus 2% range. That means the consensus estimate isn't sitting dramatically above management's own guidance. It is sitting inside it. And that creates the first problem. Imagine a student who is expected to score 90. He scores 93. Technically, he did great. But imagine everyone in the room secretly expected 99. Suddenly, 93 doesn't look impressive. The same thing happens in financial markets. A company doesn't get rewarded simply for beating a number. It gets rewarded for beating expectations by enough to change the future. And Nvidia has trained investors to expect extraordinary numbers. That is the trap. A normal company can beat expectations by a few percentage points and excite investors. Nvidia is no longer treated like a normal company. It has become the central supplier of the AI infrastructure boom. So investors aren't simply asking, did Nvidia beat revenue? They're asking, did Nvidia prove that AI spending is accelerating? And that is a much harder question. The real battle is not this quarter. Here's where the story gets interesting. The quarter Nvidia is reporting is already history. The chips have already been shipped. The customers have already bought them. The data centers have already been built or ordered. The revenue is largely locked into the past. But investors aren't really buying the past. They are buying the future. That means the most important number may not be the quarter Nvidia just finished. It may be the guidance for the next quarter. And this is where expectations become dangerous. Current estimates put the next quarter revenue expectation around the $103 billion to $104 billion area, while some bullish analysts are looking substantially higher. That means investors are effectively asking Nvidia to keep growing at an extraordinary rate, not once. Again. And again and again. This is the machine Wall Street has built. Every quarter has to be bigger than the last. Every product cycle has to accelerate. Every hyperscaler has to keep spending. Every AI model has to require more computing power. And Nvidia has to remain the primary beneficiary. That's a lot of assumptions. And when a stock is valued on a chain of assumptions, even a small crack can cause a very large reaction. Why are chip stocks selling? Now, let's look beyond Nvidia, because the real clue may be hiding in the companies around it. Several semiconductor and AI-related stocks have recently experienced sharp selling. Memory stocks have been particularly volatile. Micron, for example, suffered a major decline during the recent semiconductor sell-off. Other chip names have also been under pressure. At first glance, you might think this is simply sector rotation. But there is another possibility. Investors may be asking whether the AI infrastructure cycle is becoming too expensive. The AI boom requires enormous amounts of capital: servers, GPUs, memory, networking, data centers, power, cooling, construction, electricity, and all of those pieces have to work together. If spending slows at any point, the entire chain can feel it. This is why Nvidia's earnings are so important. Nvidia sits near the center of the chain. If Nvidia says demand is accelerating, the entire ecosystem gets relief. But if Nvidia sounds cautious, the market could start questioning the assumptions behind the entire AI infrastructure boom. And that is where the real risk begins. The 500 billion question. There is another issue investors are watching. The AI infrastructure buildout has become so enormous that financing itself is becoming part of the story. Hundreds of billions of dollars are being committed toward new AI infrastructure. That raises an uncomfortable question. Where does all this money come from? And more importantly, how quickly does that investment turn into actual revenue and cash flow? This distinction is critical. A company can announce a massive data center project. That does not mean the project instantly produces economic returns. The equipment has to be purchased. The data center has to be built. The electricity has to be supplied. The customers have to use the computing capacity. And eventually, someone has to make money from all of it. This is why investors are becoming increasingly sensitive to the relationship between AI spending and AI revenue. If the spending keeps rising, but the economic returns don't rise with it, the market eventually starts asking questions, and those questions can hurt valuations. The AI boom has entered a new phase. For the first phase of the AI revolution, the story was simple. AI was new. Demand was exploding. Companies needed GPUs. Nvidia had the best position. Investors wanted exposure. Buy the infrastructure, buy the chip makers, buy the cloud companies, buy anything connected to AI. But we are moving into a different phase. The market is no longer asking, is AI important? Everybody knows the answer. Yes. The question is, how profitable will AI become? That is much harder, because AI can be revolutionary, and some AI investments can still lose money. Those two things can exist at the same time. The internet transformed the world. But that didn't mean every internet stock became a great investment. Electric cars transformed transportation. That didn't mean every electric vehicle company became profitable. The same principle applies to AI. The technology can change the world, while individual investments still disappoint. And that distinction is becoming more important. The expectations problem. Let's imagine three possible Nvidia earnings scenarios. Scenario 1, Nvidia beats revenue. Margins are strong. Management raises guidance significantly. AI demand remains explosive. In that case, the stock could surge. Simple. Scenario 2, Nvidia beats revenue, but guidance is only slightly above expectations. Margins soften. Management sounds cautious. The stock could struggle, even though the company technically beat. Then there is scenario 3. Nvidia beats the quarter, but management signals that growth is beginning to normalize. That would be the most dangerous scenario, because investors could suddenly realize that the AI story remains strong, but the acceleration they were paying for is slowing. And when expectations fall faster than earnings, valuations can compress. That is how a great company can become a falling stock. The market's secret question. Here's the question most headlines aren't asking. What happens if Nvidia delivers exactly what Wall Street expects? Not a disaster, not a blowout, just exactly what investors expect. That sounds harmless, but it may not be, because the market has already priced in extraordinary success. A stock doesn't need bad news to fall. It can fall because the news isn't good enough. That is one of the most important concepts in investing. Good is not always enough. Better than expected is what matters. And with Nvidia, the bar is extremely high. Why the options market matters. There is another clue hiding in the derivatives market. Options traders are expecting a significant move around Nvidia's earnings. Recent pricing has implied roughly a 5 to 6% potential move in the stock. That is enormous when applied to a company worth trillions of dollars. We're talking about hundreds of billions of dollars of market value, potentially moving in a matter of hours. Think about that. A single earnings report, a few paragraphs of management commentary, one sentence about demand, one sentence about margins, one sentence about the next product cycle, and hundreds of billions of dollars can change hands. This is why Nvidia earnings have become a market event, not just a corporate event. The first big loop. But wait, if Nvidia's fundamentals remain this strong, why are investors selling before earnings? There are several possible answers, and none of them necessarily mean Nvidia's business is collapsing. The first is positioning. Investors who made enormous gains may simply be reducing risk. The second is valuation. After years of explosive growth, investors may want a better price before adding exposure. The third is uncertainty. When an earnings report can move a trillion-dollar ecosystem, some investors prefer to wait. And the fourth may be the most important. Investors may be worried that the AI trade has become too crowded. When too many people own the same story, the trade becomes vulnerable. Not because the story is false, but because there may be fewer new buyers left. The crowding problem. Imagine a theater. Everyone is convinced the show is going to be incredible. So everyone buys a ticket. The theater becomes packed. Then the show starts. It's actually good, maybe even excellent. But if there is no extra seat left, who is going to buy another ticket? That's what a crowded trade looks like. Nvidia can continue growing. AI can continue expanding. Data centers can continue being built. And the stock can still struggle if expectations have already become extreme. This is why price action before earnings matters. Not because it predicts the future perfectly, but because it tells us something about positioning. And right now, positioning looks nervous. The second loop. Now here's where this gets much bigger than Nvidia. Suppose Nvidia reports strong earnings, but the stock doesn't rally. What would that tell investors? It could suggest that the AI trade needs even better news to keep climbing. And if great news isn't enough, what happens when the next company reports? What happens to AMD? What happens to Broadcom? What happens to the memory suppliers? What happens to the data center builders? What happens to the companies selling power infrastructure? And what happens to the mega-cap technology companies spending billions on AI? Suddenly, one Nvidia earnings report becomes a test for the entire ecosystem. Hash the hyperscaler problem. Microsoft, Amazon, Alphabet, Meta. These companies are spending extraordinary amounts of money on AI infrastructure, and Nvidia benefits when that spending continues. But eventually, investors will want to know, what are these companies getting for their money? Are AI products producing revenue? Are enterprise customers paying? Are AI services improving margins? Are workloads growing? Is demand sustainable? The answers don't have to be negative, but they have to justify the spending, because capital expenditure cannot grow forever without scrutiny. Eventually, investors want returns, and that is the next phase of the AI story. From AI will change everything to show me the cash. This is the transition happening in the market. The first AI phase was about possibility. The second phase is about economics. AI can write code. AI can generate images. AI can analyze documents. AI can automate customer support. AI can accelerate scientific research. AI can transform search. AI can change advertising. AI can reshape software. But investors are now asking, how much revenue does that create? How much profit? How much free cash flow? And how quickly? That is the difference between a technology revolution and an investment thesis. What could break the bull case? Let's be fair, the Nvidia bull case is still extremely powerful. The company has enormous scale. It has a powerful software ecosystem. It has a dominant position in accelerated computing. AI demand remains substantial, and the next generation of AI infrastructure could require even more computing. So what could actually break the bull case? There are several possibilities. First, AI spending could slow. Second, competition could increase. Third, customers could develop more custom chips. Fourth, margins could decline. Fifth, export restrictions could limit certain markets. Sixth, AI models could become more efficient. And seventh, the market could simply decide that the valuation is too high. Notice something. None of these requires Nvidia to become a bad company. That's important. The company can remain excellent while the stock becomes less attractive. And now we reach one of the strangest parts of the AI story. What if AI becomes more efficient? At first, that sounds bad for Nvidia. If models require fewer GPUs, maybe Nvidia sells fewer GPUs. But there is another side. Lower costs could make AI economically viable for more businesses. That could increase total demand. So efficiency can simultaneously reduce the amount of computing required per task while increasing the number of tasks being performed. This is the classic technology paradox. When something becomes cheaper, people often use much more of it. The question is, which effect wins? And investors don't know the answer yet. The China factor. Then there is China. Nvidia's international business has also been affected by export restrictions and changing access to advanced AI hardware. This matters because China represents a huge technology market. If Nvidia can sell more advanced products into that market, that could create additional opportunity. If restrictions remain tight, the company loses potential revenue. But there is another long-term issue. When a country cannot buy the world's leading technology, it has an incentive to build its own. That means export restrictions can create short-term limitations while potentially accelerating long-term competition. For Nvidia, this is not simply a sales question. It is also a geopolitical question. The competition question. Nvidia's dominance doesn't mean competition disappears. AMD is competing in AI accelerators. Broadcom is deeply involved in custom AI silicon. Cloud companies are developing their own chips, and startups are attempting to attack specialized parts of the AI hardware stack. But competition is not simply about who makes the fastest chip. It's about the entire ecosystem. Software, libraries, developers, networking, systems, support, optimization, and compatibility. That is where Nvidia has a major advantage. But advantages that look permanent often aren't. Technology changes faster than investors expect. The third loop. So here's another question. What if Nvidia beats expectations, but management says the next generation of chips is going to be more expensive to produce? What if revenue rises but gross margins decline? What if demand is strong but supply constraints change? What if customers want more chips, but Nvidia cannot ship them fast enough? Every one of these scenarios creates a different stock reaction. That's why simply watching the headline revenue number is dangerous. You have to listen to the entire report, and especially the guidance. Margins may be the silent signal. Revenue gets the headlines, earnings get the headlines, but margins may tell a deeper story. Nvidia has historically benefited from extraordinary economics around its AI products. But as the architecture becomes more complex, the supply chain becomes more expensive. Advanced packaging, memory, networking, energy requirements, cooling, manufacturing capacity, all of these can influence profitability. A company can grow revenue rapidly while the percentage of revenue it keeps as profit changes. And Wall Street will notice, because eventually growth has to translate into earnings. What investors should listen for. When Nvidia reports, there are several phrases investors will be listening for. Demand remains strong. Supply remains constrained. Customer deployments are accelerating. Cloud service providers continue to increase capital expenditure. AI inference demand is accelerating. Blackwell demand remains robust. Next-generation systems are ramping. Those statements would support the bullish narrative. But investors will also listen for words like normalization, optimization, customer digestion, longer deployment cycles, margin pressure, supply constraints, moderation. Those words could trigger a very different reaction. The difference may be subtle, but in a stock this large, subtle differences can create enormous moves. What if the stock falls after great earnings? This is the scenario many investors underestimate. Nvidia could announce record revenue, record data center sales, strong margins, strong guidance, and the stock could still fall. Why? Because investors bought the stock expecting even more. This is called selling the news, and it happens frequently around highly anticipated events. The market spends weeks building expectations. Then the event arrives. The result is excellent, but the stock doesn't move higher. Why? Because the buyers were already positioned. There is nothing left to surprise them. And when there are more sellers than buyers, the stock falls. What if Nvidia surprises everyone? Now flip the scenario. What if Nvidia doesn't simply beat expectations? What if management delivers a major upside surprise? What if next quarter guidance jumps significantly? What if AI infrastructure demand accelerates? What if margins remain stronger than feared? Then the market could suddenly reverse. The recent selling could look like nothing more than positioning before the event. Short sellers could rush to cover. Options hedges could amplify the move. Momentum traders could jump back in, and Nvidia could pull the entire semiconductor sector higher. This is why the setup is so dangerous. The downside can be violent, but so can the upside. The market is waiting for one sentence. Ultimately, investors are waiting for one thing, not just the revenue number, not just earnings per share. They want to know whether management still sees AI demand accelerating. Because if the answer is yes, the bull market has another reason to continue. If the answer becomes more cautious, the market may start questioning the entire valuation structure. That is the real battle. The biggest misunderstanding. There is a common mistake investors make during moments like this. They assume strong company equals strong stock. It doesn't. A strong company can have a weak stock. A weak company can temporarily have a strong stock. The difference is expectations. Imagine a company growing earnings by 50%. That sounds incredible. But if investors expected 70%, the stock can fall. Now imagine a company growing earnings by only 20%. That sounds mediocre, but if investors expected 5%, the stock can explode higher. Markets are expectations machines, and Nvidia is currently carrying some of the biggest expectations in the market. Why this matters for your portfolio. Even if you don't own Nvidia, this matters. Because Nvidia is connected to an enormous network of companies: semiconductors, cloud computing, data centers, networking, power, cooling, memory, software, and the largest technology companies in the world. If Nvidia confirms that AI spending remains strong, the entire ecosystem could benefit. If Nvidia raises concerns, investors may reassess every company associated with the AI boom. This is why Nvidia's earnings have become a market-wide event. The 4 scenarios. Let's simplify everything. There are 4 major scenarios. Number 1, strong quarter, strong guidance, strong margins. That is the dream scenario for bulls. Number 2, strong quarter, strong guidance. But the stock was already priced for it. The stock could rise initially, then give back the gains. Number 3, strong quarter, weak or cautious guidance. This is the dangerous middle ground. The company performs well, but the future looks less explosive. And number 4, weak quarter, weak guidance. That could create a much larger AI sector sell-off. The market doesn't need scenario 4 to become nervous. Scenario 3 may be enough. The price does not tell the whole story. This is why watching Nvidia's chart alone can be misleading. A declining stock doesn't automatically mean fundamentals are collapsing. A rising stock doesn't automatically mean fundamentals are improving. Price reflects expectations. Fundamentals reflect the business. Valuation connects the two. You need all 3. And right now, all 3 are sending slightly different signals. The business remains incredibly strong. The expectations remain incredibly high, but the price action is becoming nervous. That combination deserves attention. The 4th loop. Here's the question that could define the next phase. What if Nvidia continues to beat estimates, but the size of those beats keeps getting smaller? At first, investors celebrate, then they become accustomed to it. Eventually, a 5% beat may feel disappointing. This is the problem of diminishing surprise. When extraordinary performance becomes normal, extraordinary performance stops being a catalyst. And that may be exactly what Nvidia is facing. The company doesn't necessarily need to stop growing. It may simply need to grow faster than an already enormous expectation. That's much harder. The $5 trillion reality. At Nvidia's enormous market capitalization, every percentage point matters. A 5% move isn't just a chart move. It represents hundreds of billions of dollars of market value. That means investors are effectively making enormous bets on small differences in future expectations. 1 percentage point of revenue growth, a few points of gross margin, a slightly higher guidance number, a slightly lower one. The numbers may look small, the financial consequences are not. The psychology of the earnings night. Picture the moment. The market closes. Nvidia releases its report. Millions of investors refresh their screens. Revenue appears. Earnings appear. Margins appear. Then, guidance. That is when the market starts moving. At first, algorithms react to the headline. Then options markets react. Then institutions react. Then analysts publish notes. Then television networks start discussing the numbers. Then social media explodes, and retail investors begin chasing the move. Within minutes, the narrative can change completely. Bullish becomes bearish, bearish becomes bullish, and everyone suddenly claims they knew it was coming. But the real information is in the details. Hash share. What would make me most bullish if Nvidia reports strong revenue? But more importantly, raises future expectations materially. That would be the strongest signal. If management indicates that demand remains supply constrained, that's even more powerful. If next generation products are ramping smoothly, another positive. If margins remain resilient, another positive. And if hyperscaler capital spending continues accelerating, the AI infrastructure thesis becomes stronger. That combination would suggest the recent selling was positioning, not a fundamental deterioration. What would make me most bearish? On the other hand, if Nvidia beats the current quarter but lowers the tone around future demand, that would be a warning. If management discusses customer optimization, that would matter. If gross margins come under pressure, that would matter. If AI infrastructure spending begins showing signs of slowing, that would matter even more. And if investors hear that customers are becoming more selective, the market could begin repricing the entire sector. Again, not because AI disappears, because the growth rate changes. The difference between a boom and a bubble. This brings us to the biggest philosophical question. Is AI a boom or is AI a bubble? The answer may be both. A technology can be genuinely transformative, while parts of its investment cycle become excessive. The internet was real. The dot-com bubble was also real. The smartphone revolution was real. Some smartphone stocks still collapsed. Housing was real. The housing bubble was also real. AI can be transformative, and investors can still overpay for AI assets. Those ideas are not contradictory, and that is why this moment matters. The AI bubble test. The bubble question isn't, is AI useful? Of course it is. The better question is, are future AI profits large enough to justify today's infrastructure spending and valuations? That's the test, and we don't know the final answer yet. Nvidia's earnings won't answer it completely, but they can give us another important piece of evidence. The power problem. There is another bottleneck investors sometimes overlook: power. AI data centers consume enormous amounts of electricity. Building the chips is one problem. Building the data centers is another. Powering them is another. Connecting them to the grid is another. This means the AI infrastructure cycle isn't limited by semiconductor demand. It is increasingly limited by physical infrastructure: land, electricity, transformers, cooling, construction, transmission. That could create another long-term opportunity. But it could also slow the speed of deployment, and slower deployment means slower revenue growth. The hardware cycle. AI hardware also evolves incredibly quickly. A company buying expensive computing equipment today may want something more powerful tomorrow. That creates a strange economic dynamic. The faster technology improves, the faster old equipment becomes less attractive. For Nvidia, this creates both opportunity and risk. Every new architecture can trigger another spending cycle, but customers also have to justify replacing hardware. If the performance improvement is enormous, demand accelerates. If improvements become incremental, customers may wait. That is another reason product cycle commentary matters. The software moat. One reason Nvidia has remained so powerful is software. Hardware can be copied. Software ecosystems are harder to copy. Developers build around tools. Companies optimize workloads. Entire technology stacks become dependent on a platform. This creates switching costs, and that's one of Nvidia's strongest defenses. But even software moats must evolve. The AI industry is moving extremely fast. New frameworks, new models, new architectures. new accelerators, new cloud platforms. Nothing is guaranteed forever. The investor's dilemma. So, where does that leave investors? On one side, you have a company at the center of one of the biggest technology transformations in history. On the other, you have extraordinary expectations. The bull case says AI demand is still accelerating. Nvidia remains the leader. New products create another cycle. Cloud spending remains strong. Margins remain powerful. The bear case says expectations are too high. Competition is rising. Customers may optimize spending. AI efficiency may reduce hardware intensity. Margins could compress, and valuation leaves less room for disappointment. Both arguments are credible. That is why the stock is so interesting. The most important lesson. But there is a broader lesson here. Investors often spend too much time asking, is this company good? The better question is, what is already priced into the stock? Because the market doesn't reward quality automatically. It rewards unexpected improvement, and Nvidia has become so successful that the expectation itself has become part of the risk. The final countdown. Now we're getting close. The report is approaching. The market has already moved. Investors have already reduced risk. Options traders are already pricing a major move. Analysts have already published their forecasts. The expectations are already embedded. Now, Nvidia gets to speak. And when it does, the market will be listening for more than earnings. It will be listening for confidence. Confidence in AI demand. Confidence in customers. Confidence in the next product cycle. Confidence in margins. Confidence in the future. Because at this point, Nvidia isn't simply selling chips, it is selling the market's belief in the future of AI infrastructure. The last question. So, what happens if Nvidia beats? The stock could explode higher. What happens if Nvidia misses? The stock could fall sharply. But the most interesting outcome is somewhere in between. What happens if Nvidia delivers excellent results, but investors realize excellent is no longer enough? That could be the defining moment. Because the AI trade doesn't need to collapse to change. It only needs expectations to normalize. And if that happens, the winners may change. The strongest companies may remain strong, but investors may start demanding better prices, better margins, better cash flow, better returns. That would mark the beginning of a new phase, not the end of AI. The end of easy assumptions about AI. For years, the AI story was about scarcity. There weren't enough GPUs. There wasn't enough computing power. There wasn't enough data center capacity. Everyone wanted more. Now, the story is slowly becoming about economics. How much does this infrastructure cost? How much revenue does it create? How quickly does it pay for itself? Who captures the profit? And who eventually gets left holding the bill? Those are much harder questions, and they are exactly the questions investors should be asking. The final warning. There is one more thing to remember. Markets can remain irrational longer than investors expect. Nvidia could crush expectations, or it could disappoint. The stock could jump or collapse. The semiconductor sector could reverse or continue falling. Nobody knows the exact reaction, and anyone claiming certainty before an earnings event like this is probably selling you a story. The smart approach is to understand the variables: revenue, margins, guidance, demand, capital spending, competition, valuation, positioning, and expectations, because those are the forces that will determine what happens next. The final moment. Tomorrow, Nvidia reports, and the entire AI trade will be watching. Not because Nvidia is the only important AI company, but because it sits at the center of the spending cycle. If Nvidia says the AI build-out is accelerating, the recent sell-off may look like a temporary scare. If Nvidia says growth is normalizing, the market may finally begin repricing the AI boom. And if the numbers are strong, but the stock still falls, then investors will have learned something even more important. The problem was never Nvidia's business. The problem was expectations. And that is the most dangerous word in the stock market. Expectations. Because when expectations rise too high, even great news can become bad news. Final CTA. So before you decide what Nvidia's earnings mean, don't just look at the headline number. Look at the future. Look at the guidance. Look at margins. Look at AI infrastructure spending. Look at what customers are saying. And most importantly, ask yourself one simple question. How much good news is already priced into the stock? Because that question can be worth more than any analyst price target. If you want more deep dives into AI stocks, technology, and the forces moving the market, subscribe. Because the next big market move may not start when the headline appears. It may start with what investors notice underneath it.